Hi everybody, Dr. Phil here. So this is going to be a video on inventories and costs of sales. So let's jump right into it. So the first thing we're going to talk about is reporting income for a service company, just because we won't spend a lot of time on that. So service companies sell time to earn revenue more so than they sell products. So think about people like auditors and accounting, attorneys, right? They don't carry an inventory. What they have is knowledge and time. So service company revenues minus expenses equals net income. Now that's a pretty common theme throughout any business, right? Money you generate minus your expenses is going to equal your net income. So what about reporting income for a merchandiser? So merchandising companies sell products to earn revenue. The difference is they don't make the products themselves, right? They just buy them from somebody else and they resell them. So examples, if you go to the mall, most of, if not all of the shops, the stores you see in the mall are going to be merchandising. So some examples here, sporting goods, clothing, and auto parts stores. So for these folks, net sales minus cost of goods sold will equal their gross profit. Notice it's called gross profit, which implies, gross implies net, right? So we're obviously not done yet. Minus expenses equals net income. So we've got a couple of examples down here. We can see H&R Block. It's an example of a service company. And you notice we've just got revenues minus expenses equals net income. And then for Nordstrom, that would be an example of a merchandising company. You can see we have net sales, we've got cost of goods sold, and that's going to give us our gross profit. And then, of course, they take out expenses, and then we have net income. So the operating cycle for a merchandiser. So the operating cycle for a merchandiser is always going to begin with them purchasing the merchandise, and it's always going to end with the collection of cash from the sale of that merchandise. So if you look at A right here, this is where they purchase the merchandise inventory. Again, remember they're buying it from other people. They're not making it themselves. They're going to sell it probably on credit. So then if they sell it on credit, they're going to generate an accounts receivable because they haven't been paid yet. And then they will collect the cash at some point in the future. And then the cycle just starts over again. So this is a good graphic of how these inventory systems work. Um, and this is true for most companies. This is one of those things that I would recommend you pause, take some time to think this through, and really understand it because it's really important. So we have net purchases, or you could just say purchases plus beginning inventory. Think about, what inventory does a business have left over from the last period? And then that's gonna give us our merchandise available for sale. And when you think about it, you knew that, right? It would have to be whatever inventory they had from left over from last period plus whatever they purchased this period. If you think about it, it makes perfect sense. So that's going to give us our merchandise available for sale. And then think about it. There's two things can happen to the inventory. It either got sold, cost of goods sold, or it didn't, and then it goes to ending inventory. And then we could even almost draw an arrow from ending inventory back to beginning inventory, because the ending inventory for one period is then going to become the beginning inventory for the following period. So two types of inventory systems, perpetual and periodic. So perpetual systems, they're going to update the accounting records for each purchase and each sale of inventory, like every time it happens. Walmart's a good example of that. You go in there, you do the self-checkout or you go through a line, and literally while it's beeping, I mean, it's ringing up your bill, obviously, but it's also crediting the respective inventory accounts real time. So when you walk out of that store, they know exactly how much they have left. We can compare that to, you think about the name periodic, right? Every now and again. These systems update accounting records for purchases and sales inventory only at the end of a period. So a lot of like fast food joints can be that way sometimes. If you've ever had a job like that, they've asked you to go do inventory, which basically just meant count the inventory, so they can reconcile it to what they're showing in the ledger. All right, so let's look at an example of a purchase without a cash discount. So on November the 2nd, Zmart purchased 500 bucks of merchandise inventory for cash. So you can see we have a debit to the asset account merchandise inventory. we have a credit to the asset account cash. So inventory is being increased. I know that because it's an asset account, it's a debit, normal balance. And then cash is being decreased. Again, I know that because cash, also an asset, it's a normal debit balance. Well, it's being credited, so it's going down. So what happened here? They just purchased inventory for cash. All right, credit terms. We would be remiss if we didn't discuss credit terms because that's, of course, is very popular the world over. So sellers can grant a cash discount to encourage buyers to pay earlier. So if we kind of express this graphically, then you're going to have sort of an invoice date. You're going to have a discount period. The discount period is typically like 10 days, maybe 15. It's like if you pay us within this period, we will give you a discount to, of course, to prompt early payment and ultimately assure collection. If you don't pay within the discount period, then you will just owe the whatever the regular full amount was thereafter through to the end of the credit period. So this is an example of a purchase discount, 210 net 30. And it's been labeled so you can see exactly what it means. So if you want to take a discount, you can take a 2% discount within the first 10 days of the invoice date. But if you don't have to do that, if you choose not to, then the net amount, the N, is due by the end of the credit period, in this case, 30 days. So here's an example of an invoice. So, most of the stuff is common sense. Who do they sell it to? Z-Mart. What's their address? We've got the name of the company over here, top left, number one. Trex. This is who sold the inventory. And then we've got the invoice date, 11/2. We've got the PO, that's purchase order date. We've got the terms. Think about the 210 net 30. If I go back real quick, just what we just discussed. FOB destination. We'll get into that later. That's free on board destination. It basically just means it's going to be sent to the destination, and title to the goods will pass from the seller to the buyer at the destination, which is usually the buyer's place of business. And then we have some information down here about what did they actually sell. At the bottom, we've got the total amount, 500, total list like units, and then excuse me, not units. That's the cost, and then there's a net discount if they were to take that of 490. All right, so let's look at purchases with cash discounts. We have the gross method and we have the net method. So it says on November 2nd, Z-Mart purchased 500 of merchandise inventory on account. Credit terms are 210 net 30. So you can see where they just debited merchandise inventory. They increased the asset account merchandise inventory, and they increased the liability account accounts payable. So we've got inventory, haven't paid for it yet. So it's been recorded in accounts payable, so we know we have to pay for it in the future. And then this one is discussing payment within the discount period. So it says on November the 12th, Z-Mart paid the amount due on the purchase of November 2nd. So here, what they're doing here is they're removing the account payable. They are debiting or decreasing accounts payable. They are removing, they are basically decreasing inventory by 10. The reason they're doing that is because your inventory has to be recorded at the cost you paid for it. Well, because they're taking the discount, the 10 bucks, the 2% of 500, they're not entitled to say that they have 500 bucks worth of inventory because they don't. Don't think of this merchandise inventory as like they're sending inventory back. That's not what they're doing. They're just saying, okay, well, we know we have the accounting rules say we got to record inventory at what we paid for it. Because we took the discount, we didn't pay 500. We only paid 490. So they're just removing $10 of value from inventory. All right, no physical inventory is going back. And then they are crediting or decreasing cash in the amount that they paid. And again, that's net of the discount. All right, so after we post these entries, the accounts involved look like this. We can see accounts payable. We can see where we first added it on November the 2nd. We can see where it was subsequently removed because it was paid. Merchandise inventory was initially recorded at 500 because maybe we didn't know if we were going to take the discount. When we did take the discount, remember the 2%, we only paid 490. So we had to remove $10, again, of value, not inventory. We didn't send inventory back. We're just recording inventory at what we paid for it. And then we have the cash. Of course, cash is an asset account, normal debit balance, increase on the left. We're paying money out, so cash needs to go down. So we have a credit to cash of 490. All right, so what about payment after the discount period? What if you don't take the discount? Then you just have to pay the net amount, right, per those terms. So it says on December 2nd, Zmart paid the amount due on the purchase of November 2nd. So they just record a debit to accounts payable and they record a straight credit to cash. No need to worry about any discount now because that period has elapsed. You're no longer eligible for that. All right, so let's talk about purchases with returns and allowances. So a purchase allowance, this is a price reduction to the buyer of defective or unacceptable merchandise. So basically, there's something wrong with it. And a lot of times the seller will make an allowance because the seller doesn't want them back. The seller doesn't want it to be their problem again, right? It's easier just to give an allowance to the buyer. Purchase return, merchandise returned by the purchaser to the supplier. So that's just a straight return. So let's take a look at an allowance. So on November the 5th, Zmart, who is the buyer, issues a $30 allowance from Trex for defective merchandise. So what they're doing here is they are debiting or decreasing accounts payable, and they are crediting, lowering merchandise inventory. So accounts payable is being lowered because the buyer gets the allowance, right? So that's $30 that they're no longer going to have to pay. So they are removing it from accounts payable. They're lowering their bill basically. And then merchandise inventory is being credited or decreased again because what do we say about inventory? It has to be recorded the value that you paid for it. So if the value it turns out is worth $30 less, then that has to be removed. That value again, not inventory itself going back. This is not a physical return of inventory. This is just value being returned. All right, so what about purchases returns? So Zmart purchases 250 of merchandise on June 1 with terms 210 net 60. So again, 2% discount within 10 days, or you can just pay the net within 60 days, so 2 months. On June 3rd, Zmart returns 50 bucks of goods before paying the invoice. When Zmart pays on June 11th, it takes the 2% only on the $200 remaining balance. Okay, so that's important to think about. If there's been any returns, then obviously those returns would not count towards your discount. So we can see on June 1, we have a debit to merchandise inventory, and we have a credit to accounts payable where they purchased the goods. On June 3rd, we have a debit to accounts payable. We're now reducing accounts payable by that 50 because there was 50 bucks of goods returned. So you're not going to pay that, obviously. And then merchandise inventory is 50. Now, in this case, the 50 here for the credit to merchandise inventory, that actually is a physical return of inventory because it says they return goods to the seller. And then on June the 11th, they're like, okay, we need to square up the bill. Let's just get it paid. So they owe 200 because they originally owed 250, right? But they had $50 of inventory sent back. So they're going to say, okay, well, we owe 200, so we're going to have to remove that. We're going to credit merchandise inventory in the amount of $4. Why? Because they basically at this point, they can still take a $4 discount, right? They owe 200, the discount is 2%, so that of course is the 4. So again, the merchandise inventory on this June 11th transaction, this is not them returning inventory. This is just, again, the inventory's got to be recorded for what you actually end up paying for it. Didn't end up paying 200 because we took a discount. We're only going to pay 196. So we're just removing that $4 of value from the inventory account. And then we have a credit to cash for 196 to represent the check that we sent. Excuse me. All right, purchases and transportation costs. So obviously we have the seller that gets shipped out. That's the cost of shipping point. We have the goods in transit, however it gets there, and then we have the destination. So there's two terms, FOB shipping point and FOB destination. So if it's FOB shipping point, ownership transfers at the shipping point, and then goods in transit are thus owned by the buyer. If it's FOB destination, then the ownership transfers at the destination, and once they kind of arrive at the destination, is almost always the buyer's place of business. Then up to that point, the goods in transit are owned by the seller. All right, let's look at transportation costs. So Zmart purchased merchandise on terms of FOB shipping point. The transportation charge is 75 bucks. So they're debiting merchandise inventory and they're crediting cash. So again, the way the inventory rules work is the inventory, the value of the inventory in that account can include not just the inventory, but also any like ancillary costs like these. So what they're saying is, okay, well we paid 75 bucks um, to get the inventory. So we're going to add that to our inventory account, right? So we're increasing inventory by 75, not because we're getting more inventory itself. Again, inventory's got to be recorded at what you paid for it. We're now going to pay well, they're going to pay an extra 75 bucks, so we're just recording that. And then they're crediting or decreasing cash to recognize that they spent 75 bucks on this freight charge. Here we just kind of see like an itemized cost of their purchases. So we've got the invoice cost of their merchandise purchases, 235.8, less purchases discounts received, 42, less any returns and allowances that were 1,500, and then they added in, okay, we paid 2,300 for transportation in, so like freight. So their net cost of merchandise purchases was 232.4. And then here is just an example of a gross profit computation. So gross profit is just going to be sales or net sales minus cost of goods sold. So 314.7 minus the cost of goods sold of 230,400 is going to give us this gross profit of 84.3. All right, let's talk about sales of merchandise. So each sales transaction for a seller or merchandise involves two parts. So firstly, the revenue is recorded and the asset is increased from the customer. And also, alongside this is another example of the matching principle. Cost of goods sold incurred that's decreasing an asset to a customer. So let's take a look at an example of a sale without cash discount. So Zmart sold $1,000 of merchandise on credit. The merchandise has a cost basis to Zmart of 300. So the revenue side entry is, and you're going to see this a lot, is a debit to accounts receivable. So we're increasing the asset account receivable, and they're increasing the equity account sales. So they're basically saying we sold stuff, but we haven't been paid for it yet. We'll get it in the future. And then the cost side journal entry, again, that would be matched. This is matching the expense with the revenue. We're debiting cost of goods sold. We're increasing cost of goods sold. And we are decreasing merchandise inventory because think about it, inventory is being shipped out in the amount of 300. All right, so sales discounts on credit sales can benefit a seller by decreasing the delay in receiving cash because you're incentivizing early payments and reducing future collection efforts. So this is just the same as what we talked about already. So no need to spend any more time here. All right, so let's look at sales with cash discounts. So Zmart completes a 1,000 credit sale with terms of 210 net 45. So you can see where they first debited accounts receivable, credit sales, to represent the sales part of the transaction. And then also on November 12th, literally right behind this first journal entry, they debited cost of goods sold, credit merchandise inventory for whatever their cost of the sale was. That's the cost of goods sold. So we're just matching the expense 300 with the revenue of 1,000. Now, if the buyer pays within the discount period, then the journal entry is we're gonna have to reflect the discount. Of course, it was 2%, right? 210 net 45. So the buyer is only going to send us 980, right? Because they're going to take that 2% discount. So the company would increase or debit cash for 980. What they'll do is they'll set up an account called sales discounts. Um, and that will be debited in the amount of 20 to reflect the discount taken. And then we will remove the account receivable of 1,000. If the buyer pays after the discount period, then it's simple because it's just a debit to cash and to increase cash, and then a credit to accounts receivable to lower the account receivable. So sales returns and allowances typically will involve dissatisfied customers and the possibility of lost future sales. So we know that we kind of touched on this already. Sales returns refer to merchandise that customers return, obviously, but sales allowances refer to reductions in the selling price of merchandise sold to customers. So ideally, if you can convince them to keep it, just make an allowance. It's a lot better than a return because if it's returned, it's kind of the seller's problem again, if you will. So let's look at a couple of examples here of sales with returns and allowances. So the customer returns merchandise which sold for 15 bucks and cost 9. So what the company is going to do is they are going to debit, they're going to set up this account, sales returns and allowances. This is what we call a, same with sales discounts, we're going to call that it's called a contra revenue account. So they're going to debit or increase sales returns and allowances, and then they're going to credit cash because ultimately they have to return the cash to the buyer. Now, what if the goods are returned but they're not defective? Then what they'll do is they'll just debit merchandise inventory. They're basically just putting it back in merchandise inventory, and they are just reversing this cost of goods sold entry for $9. Let's try that again. There we go. So what if a buyer is granted an allowance for defective goods? So assume that $40 of the merchandise Z-Mart sold on November 12th is defective, but the buyer decides to keep it because they offer them a $10 price reduction. That's smart. So what they'll do here is they'll just debit sales returns and allowances for 10, and they will credit cash for 10. So basically, Z-Mart is saying, we don't want it, we really don't want it back. If you keep it, we'll basically give you a $10 concession. So that's what they've done. So here we just see the merchandising cost flow in the accounting cycle. You could, if you wanted to, you could kind of pause this here. You're also seeing the financial statements at the top here. So from the supplier, we have our net purchases plus beginning inventory, kind of what we talked about already. And that's going to give us for each period, like look, it says period 1, period 2, the merchandise available for sale. And then we're going to have cost of goods sold for what we sell each period. And then we're going to have ending inventory, which is then going to be transferred to the period 2. And then if you notice, this is exactly the same as period 1. And it's just a cycle, right? It just keeps repeating itself. Just real quick here, I'll just mention that cost of goods sold belongs on the income statement. So think about like revenues minus expenses. Cost of goods sold is really just another type of expense, a very specific one. Um, and then notice it says ending inventory on the balance sheet. And the reason that is that because until you sell it, it's your asset, right? Like your business's asset. It's not one you want to keep. You didn't buy it to keep it, right? You bought it to sell it. But until you sell it, it belongs on your balance sheet because it's your asset. All right, shrinkage, the adjustment to reflect the loss of merchandise through theft, spoilage, whatever other myriad of other reasons. So here's an example of adjusting for a $250 shrinkage. So what most companies will do is they'll just increase cost of goods sold, in this case for 250, and then they will lower merchandise inventory. So again, this isn't inventory being sold. This is just saying, okay, there was some kind of problem. It's been stolen. It's lost for whatever reason. You still got to pay for it. So we're going to debit cost of goods sold, and we're going to credit merchandise inventory for that amount. The sales discounts and returns and allowances. We fairly recently we have new revenue recognition rules that require reporting of sales at the net amount expected, no longer the gross. Thus, adjusting entries are required for number 1, expected sales discounts, number 2, expected returns and allowances on the revenue side, and then number 3, expected returns and allowances on the cost side. So what about closing entries for merchandisers? Remember, like closing the books at the end of the period. It's not too dissimilar to what you would see for a manufacturing company. So they're going to close sales to income summary. So they're debiting. So remember, sales is a normal credit balance. So if you want to close it, it's got to be a debit. So they're debiting sales, and they're basically just transferring that amount to income summary. And then they are closing all the accounts that have normal debit balances. So all these like sales discounts, sales returns and allowances, cost of goods sold, etc. All of these they're putting credits because again they're normal debit balances. If you want to close it, you need to do a credit. So that's what you're doing here. And then it's being the total amount, this 3081, is being debited to income summary. The difference between the 321 that was sent over from revenue and the 3081 that was sent over from basically our expenses is the 12,900. So they're basically now in step 3, they're closing income summary out to retained earnings. And then the last thing they're doing is just saying, oh, did we pay any dividends? Yes, we did. Okay, we know that dividends have a normal debit balance. So if you want to close them, you need to put a credit. So that's what they're doing. They're crediting the dividends account in the amount of 4,000 to just close it out, zero it out. And it's being transferred to retained earnings. So you could say retained earnings went up by 12,900, basically net income, and then it went down by 4,000 because of dividends. All right, so adjusting and closing for the merchandise entries. So you can see the events here, adjusting for shrinkage. They're just going to debit cost of goods sold. They're going to credit merchandise inventory. Closing temporary accounts with credit balances, it's not really any different. They're just going to debit sales, credit income summary. And then for any accounts with debit balances, just like we said, if it's a debit balance, it needs to be closed with a credit. So you see all these credits. And then, of course, the debit would be to income summary. All right, almost done, almost finished. Multiple step income statement. So here you can just see how they've kind of broken this out. You got your sales, you got cost of goods sold, you got your gross profit here in the red, 84.3, and then they've got their selling expenses. Total selling expenses of 42.1. We've got general and admin expenses. Total G&A expense of 29.3. So thus we have total operating expenses. That's the 42.1 and the 29.3 added together, 71.4. So we have income from operations of 12.9. And then we have any other revenues and gains. So the stuff you see in other revenues and gains is more ancillary, like side kind of stuff. And then you can see our net income here of 14,900. Or we can just do a single step income statement, which is we just kind of bunch them all together. You don't get the detail that you do here. So most companies would never do this one. Most companies are always going to do this multiple step income statement. But you'll still get the same number ultimately, 14,900. I've talked about this in another video, but the idea of a classified balance sheet is you kind of like classifying things into different categories. So like cash is one, accounts receivable, merchandise inventory in this case. And what they're showing you over here is the liquidity, right? Liquidity is defined as kind of like nearness to cash, like how quickly you can turn it into cash. So obviously cash is the most liquid asset. You would hope that accounts receivable were pretty liquid because you want to get your money. Merchandise inventory should be liquid too. That's the one they're drawing attention to here because that's selling your inventory. That's what you're in business to do. All right. Excuse me, the acid test ratio. So this is a stricter measure of liquidity than the current ratio. So the acid test ratio is simply quick assets divided by current liabilities. The quick assets are defined thusly: cash plus short-term investments plus receivables, and then just divided by current liabilities. So a common rule of thumb is the acid test ratio should have a value of at least 1.0. Basically, for every dollar of current assets you have, there's a dollar of current liabilities. If a company has a ratio of at least 1, then they are unlikely to face liquidity problems in the near future. That's kind of a general rule that we use. So, and here's some examples of some acid test ratios. So you can see, like for Nike, current year 1.1, it was 1.4. So this is a ratio again, kind of the higher the better, right? So a couple of years ago, their liquidity was much stronger, 1.8, than it was a year ago, 1.4. So if you're Nike, you might be kind of looking at this thinking, okay, this trend continues. If this goes below 0, then that would indicate that we have more current liabilities than we do these quick assets at the top here. And then finally, the gross margin ratio. So this is just simply net sales minus cost of goods sold, and then just divided by net sales. So you could think of this as the percentage of dollar sales available to cover expenses and provide a profit. So you can see down here, just a hypothetical company, 44.6 2 years ago, 43.8 last year, and 44.7. So it isn't really going up or down. It's staying about level. All right, thanks for watching the video, and I will see you all soon.